Let's move on. TeamLease has seen a very weak set of first quarter earnings. There has been margin decline across segments, with consolidated figures seeing a 90 basis point slip. To discuss the outlook and hiring trends, we are now joined by Ramani Dathi, CFO at the company. Sonia, let me pick it up. Sorry.
All right, Ramani, thanks a lot for joining in. This is Sonia here. I just wanted to talk a little bit about your earnings, because I think we didn't speak about it post your numbers coming out. Your margins across segments have declined quite a bit, and you're already sitting with low single-digit margins, right? In Q1 of FY23, your consolidated margins were just 1.3%. So just trying to understand, by the end of the year, what kind of margin trajectory are you looking at, and why is it that you're seeing so much pressure?
Thank you, Sonia. So firstly, in terms of top line growth, we are seeing very good demand. Even this quarter, we have added 13,000 headcount in our general staffing business, and we crossed 2 lakh overall headcount in our staffing business. So what exactly has impacted our margins in this quarter particularly are three reasons. So one is the inflation in our associates. Typically, we used to have 5 to 6% salary inflation in the associates that we have in our general staffing business. Last year, it was almost 11 to 12%. So with the gross salaries going up, that has put on a pressure in terms of our percentage margins. While the absolute margins are improving in our staffing business, as a percentage, this increase in top line is putting pressure. That's one reason. Second one is specific to this quarter. So there is a higher hikes given to our core employees as well. Again, historically, we have been giving about 7 to 8% hikes to our own core employees. And this year, matching the market demand and the corrections that are required to be made, we also have ended up giving 12% hikes to our core employees. So that has led to almost a 5-6 crore increase in our costs in this quarter. The third one is there are few one-time impacts, like we have an EdTech business. So typically Q1 with holiday season for almost all universities, no admissions happening. So there is a 5 crore impact straight away coming from our EdTech business. So it's largely on account of the salary inflation, and all the costs are fully absorbed. So we are very positive about the outlook for the upcoming festive season. So with the cost being fully absorbed, we are confident of taking the year-end margins back to last year numbers that we have posted.
Ramani, hi, good morning. Prashant here. So what will it look like? Now you're saying that a lot of the pain is in, you've taken the cost increases that you had to. So could you give us some guidance on what realizations will look like, what margins will look like for the full year?
Yeah. So from Q2 onwards, Anuj, we are consistently, Prashant. So we are looking for a consistent quarter-on-quarter expansion in our margins. We don't give an exact guidance, but we are hopeful of closing the year with the margins what we closed with last year. And this is mainly on account of operating leverage coming from our staffing business, because as I mentioned, the costs are fully absorbed, the growth will straight away contribute to the bottom line, and the contribution from our higher margin businesses like IT staffing, EdTech business. So those are also increasing. So with that, we are confident of taking the margin upwards.
Okay. You, in the conference call, you had said, Ramani, that you're witnessing a tightness in manufacturing sector, layoffs and deferred hiring, but subsequently open positions are increasing and demand seems to be coming back in Q2. Can you explain what exactly happened and what is the takeaway from that from an investor standpoint?
Sure. So in the beginning of the year, we have expected very high demand from manufacturing, infra and engineering industries, maybe with the back of PLI schemes and other initiatives by the government. But unfortunately, we are not seeing that much of demand on the ground within manufacturing and engineering segments. So while there is a little bit of sluggishness there, we are seeing better outlook from other industries like BFSI, retail, telecom, because retail for a long time has continued at very low numbers because of COVID. Now that with all the retails being opening, the physical retail as well as e-commerce being back, so we are seeing very strong outlook and demand there. But at this point in time, manufacturing and industrial still seems to be low.
Okay, all right. So can you give us some guidance in terms of hiring? What are you looking at for this year? And also the general staffing, I think, was around 13,000 between last quarter and this one in Q1. general staffing hires. What is the guidance for the next few quarters?
Yeah. So we are planning to have at least 18 to 20% headcount growth in our general staffing business this year. So this is the minimum number that we are confident. In case if there is a recovery and better numbers by the festive season in Q2 and Q3, we may close with a slightly better numbers as well. So last year we did about 57,000 headcount in our staffing businesses overall. So we should come close to that number this year as well.